Hey guys, we're here with Agile Wealth Weekly. We've got the team here, and we've got a good topic for you, and it's often one that's a little overlooked. It's when you talk about life insurance and retirement, you kind of get some of those ugly faces, don't we? When we do. So we're going to demystify a little bit of this and talk about how life insurance is used in retirement. We've got five ways that it can be used, and there are a multitude. I'm John Oliver.
I'm Nick Bohr.
I'm Steve Livingway.
So let's get right into it. The first one we talked about is the ability to diversify your portfolio with life insurance. So how can we do that with life insurance and diversifying our portfolio? It doesn't make any sense.
Well, I've done this for years myself personally with clients, is that you can use, if it's structured in the proper manner, meaning structuring it as and with the intent of using it as an asset, you can actually build and have access to cash value that can have some tax advantages and can also help grow your portfolio. So diversifying, having certain types of life insurance that maybe isn't tied to the market and is just has a fixed rate of return, or has different types of other types of life insurance that you're not going to go down when the market goes down. There's advantages there in helping you diversify your entire portfolio, depending on where you're at, depending on what your risk level is, and also depending on what the rest of your portfolio looks like. Bonds are usually used as a fixed portion of your portfolio. And if you don't realize this already, you should definitely be seeing more and more information about this out there, that bonds are at all-time highs and interest rates are at all-time lows, and the chances that you're going to earn much more than 0.5% to maybe 1.25% to 1.5% on bonds in the next 5 to 10 years is very, very, very unlikely. Really slim to none. What's John? I know you told me the other day a recent article or Vanguard recently came out. What did they say?
Projected returns on.
What are the projected returns on bonds?
So aggregate bonds is taking them all together. Projected return is between 1 and 1.5% over the next 10 years. And if you take the real rate of return, so you take inflation, it becomes a negative or maybe a flat return on your bonds in the next 10 years. So if you had a whole life policy right now that's earning like 4.35%, I'd be pretty happy right now.
Yep. Yeah, and there's other types of policies, as you guys are both aware of, but just to make sure you guys are aware, there's other policies that can still grow at 4 or 5, some even 6%, even though, when we're doing retirement planning, John and I are definitely looking at this more on the conservative standpoint, meaning, if it's earned 6 or 7% over the last 10, 15 years, we may only be assuming 5 or 5.5, just to make sure that we're going to reach the goals and the objectives that you seek out.
So I know, Steve, you are probably the most, something that you're most excited about with life insurance is the taxation capabilities of it. Can you explain a little bit about how you can reduce taxation with life insurance and retirement?
Well, number one, the death benefit is tax-free in life insurance. So if you're looking at passing on some money to a loved one, a child, a spouse, there aren't that many things in life that are tax-free. Life insurance is one of them. You have tax-deferred growth in the life insurance product, and you can have a tax-free cash flow. You can borrow against your life insurance product, and it's one of the few products that are out there that are tax-free. And I also wanted to mention, one of the reasons we want to talk about life insurance, whole life has a bad rap. In my generation, I didn't want to talk about whole life with anybody. And as I got into this business, I learned more and more. People are losing out on so many uses of life insurance in their total planning only because of that bad rap. They don't want to talk about it. So I'm really excited about getting this information out there today.
So you're telling me you can take distributions from a life insurance product. How is that tax-free? That doesn't seem right.
So the way it's tax-free is you obviously fund it with after-tax dollars, and your accumulation is all tax-deferred, just like your 401k or IRA would be. And the way you can pull distributions out of the policy is up to a portion or all of your cost basis, completely tax-free. And then from there, you can structure it this way up front, where you plan on taking loans from the policy, never intending to pay them back. And just to kind of follow up on what Steve just mentioned, I absolutely.
You're doing a better job explaining it.
Listen, I absolutely agree, Steve, though, that whole life and permanent insurance itself has definitely gotten a bad rap over the years. And it's, unfortunately, we all know that there's bad apples in every industry. And it's unfortunate that a big reason it's gotten a bad rap is because of the sales environment where it's just misused. Hey, you need a whole life because it's what you need, even though they've done no planning, there's no strategy to it. When we sit down with a client, our whole idea to help them is financial planning, meaning how does life insurance intertwine with it? How do your investments impact your future taxes? How can life insurance possibly decrease? Are you concerned about long-term care? Like, all of these things are talked about when we do planning. So it's definitely a big difference when we talk to clients about life insurance and the benefits of it. Yes, sometimes it's still a little bit hesitant to overcome because of maybe they've heard bad things, maybe they've had a bad experience. Sean, how many clients have we actually talked to when they first come in that we bring up life insurance on some form and they're like, whoa, wait a second, you want to talk about what?
Yeah, those are the eerie faces that I mentioned at the beginning.
Yeah, exactly.
When you do it in a planning context, it makes a whole lot more sense. When you say, okay, well, the reason why we're doing this is because of this, then you get happy faces. And another reason, unfortunately, life insurance does get a little bit of a bad rap is because, especially if you look at somebody that's in their 50s now and they're looking to retire and they've done a good job growing their portfolio, the last 10 years, the market's been straight up. So They just think, well, I'll just have cash over here and stocks over here. Well, it's not actually very realistic. You need a fixed bucket, and your fixed bucket might include life insurance. So let's keep moving on.
Yeah.
This is probably the number one reason that we usually continue to use life insurance in our planning, is to protect a spouse from the loss of income. So what would happen, and how could life insurance fulfill that need if say, for example, we've got two clients, we got Gene and Mike passes away. What happens to Gene?
Let me talk about this one, because this is actually, even though it's the most traditional way we're looking at life insurance. For example, in my situation, my wife is really dependent on my income. She sacrificed, stayed home, raised the kids. And so I retired from being a principal. I have a pension. I named her as a full beneficiary, but I'm still working. So number one, my loss of Social Security income she might lose. She could claim on mine, but at half. Mm-hmm. She'd be losing this work that I'm doing. I mean, she would need that protection, and I need that peace of mind. I need to know she's going to be okay if something happens to me. So that's probably, even though it's the traditional, part of it, I mean, that to me is one of the most important parts that you don't want to overlook. You want to have that peace of mind.
Unfortunately, though, when we get to that point with our clients, we're saying, so how much, life insurance, you're like in your 50s, like maybe 60. How much life do you have? Well, we got $200K at work. Right. That's going to end when I retire. Yep. So you think basically there's no life insurance need in your 60s?
Well, I was in that same mindset that, when I'm younger and working, I need more insurance. I bought a bigger term policy. And I've really reframed my thinking in, I'm going to be retired, if I'm lucky, 40 years. Mm-hmm. My wife is a little bit younger, probably healthier. Women live longer. She might be lasting 50 years and relying on this income. Mm-hmm. I think it's more important now than ever.
Well, and so I agree with that in regards to, yes, life insurance can definitely play a factor in a loss of income. The big things that aren't usually thought of, Social Security. Okay, so if you get to the point where you're both on Social Security, a lot of times the clients we deal with, there's a lot of instances where the one spouse has a bigger Social Security than another. So I'll use an example of the one spouse is getting $2,000 a month. The other spouse, Steve, like your situation, your wife stayed at home. So more than likely, she's going to collect on half of yours.
Right.
So if we use those exact numbers, Steve, the husband's going to get 2,000, the wife's going to get 1,000. What most people don't know is in the event the husband passes first, the wife will keep the $2,000, but they lose their 1,000. And for a lot of people, $1,000 a month, especially when they're relying on it, that's a big factor. So those are things that life insurance could really help take some burden off. The other thing, Steve, you mentioned part-time work. You know, the other thing we didn't talk about, state employees like yourself, where you retired from, you had the option to take 100% in your pension for your spouse. Most others, like GM, Ford, Chrysler, some of the other employers do not allow 100% to spouse. A very common one is 65%, or 2/3 to spouse, and you lose 1/3. So let's use easy math here for a minute. Let's assume your pension's $1,800 a month. That means your spouse is going to lose $600 a month if you pass before them.
Plus the Social Security.
Yeah.
Correct. I've had
Plus the part-time work.
Correct. And I've had numerous situations over my 18-year career where I bring this up and the wife looks at me deer in headlights. Like, has no idea.
Think of that.
Looking at the husband like, what?
Yeah.
You're telling me I'm going to lose $1,600 a month? And usually, you know, the husband looks at it and says, okay, well, you know, some of the costs will go down a little bit, a little less food.
We have some money.
And I usually I joke and I say, number one, I get the lower cost, but I will usually step in right away and say, I'm assuming you don't cost her $1,600 a month. And the husband usually chuckles and laughs and says, no, maybe $500-600, but not the full. So these are things when you're doing planning that is important to look at. I want to bring up one thing we didn't talk about in the, you know, it doesn't really go with the taxation. It probably goes more in this section real quick. But the other thing that I think life insurance is not used enough in, you guys, we talk a lot about how annuities can give peace of mind and guaranteed income. What about using life insurance to provide and allow the clients to be able to spend a little bit more of their assets while they're both alive and able to enjoy and travel and do the things because they know they have $200, $250, $300,000, whatever it is, backing up the surviving spouse. So I think that's an important point.
So that just in case I can't spend any of my money, it's gone.
Correct.
Because you know, just in case you've got life insurance.
Correct.
So we would always say, you know, it's kind of like that nest egg replacement. It's why not take 10 or 20 or even 25% of those assets and actually utilize them to leverage yourself some life insurance, and then just go spend the rest of the money because you know you actually have it coming back when one of the persons passes away.
Well, it's interesting. So you remember this. We implemented that recently with one couple, that there was like a 10-year age gap difference.
Which is important.
And you know what? The husband really didn't feel like, he kind of saw the need for life insurance. It was actually the wife that didn't see the need for it at all until we showed them, look, they had one investment account they were kind of earmarking to help replace a little bit of the investments. And we showed them as part of the plan, let's spend this now in retirement and the life insurance is going to back you up. And it actually made their income go up. It made, at the end of the day, the husband walked out of here like, oh, big gorilla off my back because now I know she's taken care of no matter what happens. And those are the types of planning strategies that we're talking about, and I think it's important to consider in today's environment.
So you might hear the words bucket strategy. So if you use a certain bucket to spend down over the first 10 years of your retirement, you should insure that, because what happens if you spend that down, but at the same time, you pass away shortly after, and the wife's sitting there saying, you know, I still have 20, 25, 30 years of retirement, because they were a 10 plus year age gap.
Right.
Let's go to the next one. You've heard, and if you look at long-term care articles nowadays, you'll see a lot of times, you'll see life insurance, long-term care rider. It gets confusing. There's long-term care in my life insurance. So how can we use life insurance in retirement to actually help give somebody a long-term care benefit?
So, long-term care has evolved a lot over the last 10 years. A lot of people still think of long-term care as the use it or lose it insurance, and most of us don't want to think about needing long-term care, but they know it's becoming more of a reality. Just because we're living longer, it's a lot more common for people to live into their 90s. Life insurance, a lot of insurance carriers about 5 to 10 years ago have now started building in or giving the option to add what's referred to as creating a hybrid policy, to where you have a life insurance policy, but if you need long-term care, whether it's in-home, in an assisted living, at a nursing home, or even at an adult daycare center, there's a lot of options out there that you can accelerate your death benefit from your life insurance policy to help also cover the cost of long-term care. So there's a lot of things there that if that is something that you guys are concerned about or you're thinking about as part of your planning, it's things that should come to mind that, hey, I heard some of these things are out there. What questions should I ask? What things should I be looking at?
So I know, Steve, you've done some research recently on long-term care and how it's becoming more prevalent, and you've got a personal story. So why would someone actually use life insurance to actually protect themselves from long-term care? I mean, it doesn't make sense, but now we're seeing that it's just becoming such a prevalent thing in late stages of our life.
Especially if I think the statistic, it was north of 85% between you and your spouse. You're gonna need, one of you for sure is gonna need long-term care. And if you don't have a way through leveraging your money through life insurance, you're gonna be paying out of pocket. And you could, the average cost of a nursing home, Nick, is something like $150,000 a year for a private room. That's just one type of long-term care, but
private room, depending on the area, you're talking somewhere between $9,000 and $11,000 a month. So probably 125, not far off.
Real quick, we're saying private because so just understand, if you don't choose private and pay for it, it's not a private room. You're usually bunked up with somebody. So
Correct.
just think about that. And home health care also has its costs, and they're very similar, but at the same time, you have to often modify your home. So there's some additional costs in that.
So strangely, the more assets you have, probably the really more important it is to really think about long-term care and how you're gonna be providing for that for you. Imagine it's your spouse. You maybe aren't gonna wanna settle for the Medicaid room with who knows who as the bunkmate, and you're gonna want the best care possible, and you're gonna be paying for it one way or another. So this is a great way to look at it.
I'm the most simplest, and I don't want to get too deep, but for example, you're telling me I can pay for a life insurance policy, maybe I have a $350,000 death benefit. So obviously there's a ton of leverage there. So how could I use that $350,000? The insurance company is going to tell me that I can actually tap into that for long-term care?
Correct. If you just like traditional long-term care, if you can't do 2 of the 6 activities of daily living, then you will be eligible for an acceleration benefit if that company allows that, which, like I'm saying, a lot of them are now. And if you use the right company that will offer that, you can then go to the insurance company, show that you can't do 2 of the 6 activities of daily living, and boom, now you can start accelerating that $350,000 and use that.
Just think of that for just a minute and just say to yourself, wow. The leverage on that it's uncomprehensible. I can't necessarily, when we do planning for that, and we show the difference of like what they could have for income now if they do something like that, or we always say to them, well, if you don't, then in those later years we've got to plan for additional income towards long-term care, which zaps their income. We can't actually provide them with the guaranteed income stream that they want.
Let's make it clear. You're not paying $350,000
No.
to get $350,000 of a death benefit or accelerated benefit for long-term care.
Steve.
You're not paying that much money You know, I don't know what it would cost, but maybe 3-to-1, 4-to-1 for your dollars.
Yeah, usually when we look at strategies like this, you're talking 3-to-1 or 4-to-1. Some strategies that we're using, especially if we build in inflation to where it goes up over time, we've seen 5, 6. We've even seen some that are like 8 or 9-to-1.
Yeah.
I mean, so we've had a lot of clients that when we do planning, they've come in saying, I think I can self-insure for long-term care because I've done a good job accumulating and saving. After looking at certain strategies and going through the planning process with us, they see the leverage and they understand, like, why do I want to spend dollar for dollar? And you're telling me that if I don't use this, it's going to my heirs, whether it's my spouse, charitably minded, you know.
Tax-free.
Yeah, or my kids, whatever. Yes.
Wouldn't you rather leave another $500,000 to a charity or your kids or a school than?
And oh, by the way, if I need long-term care,
It'll cover it. It'll cover it.
So it makes a lot of sense. So we're going to tap on the last point here, probably the most important point. But as you do this planning and use life insurance to fulfill some of these needs, the last and most important thing that you get out of this, guys, is happiness and peace of mind. And that goes such a long way for your health, your wellness, and just your mental clarity as you go through retirement. I mean, if you're happy and you have that clarity of why you're doing what you're doing, and you have that peace of mind, it's priceless. You really can't put a price tag on it.
It's not only priceless. There's been a lot of studies shown that the less stress you have around things like that in retirement, the longer life expectancy you can expect to live. And a longer one that you can expect to live while you're healthy.
Yeah, and enjoy, right?
We mentioned it a little bit, but we see a lot of people live that just in case retirement.
Right.
Yeah.
I can't touch my money just in case. I can't travel just in case we need it, just in case someone gets sick. This takes all that off of your plate, the peace of mind, and you can actually do all the things you've always wanted to do when you're retired.
Yeah.
I mean, that's just worth its weight in gold.
It's so true. It's having the peace of mind is the thing that's going to allow you to live the life that you really wanted to at the age that you want to do it. When you go into do holistic planning with a financial planner, you've really changed the way you look at things. And instead of saying, well, I'm going to, we see a lot of times kind of two strategies, like the initial bucket. I'm going to kind of spend this first bucket and then my money should be X at the end of this 10 years. So it's like, I mean, really? I mean, are you really going to hope that your money's going to double in the next 10 years because you're going to spend this bucket down? The bucket you spend down, not going to do anything. So that's the aggressive. And then we see the other side of the table, the just in case retirement. Well, I really can't spend anything. I'm living, on every little dime that I have. I can't enjoy it. Next thing you know, you're 72, 75 years old. You've got a back problem. You're not going hiking in the mountains.
You're not traveling. All of a sudden, you're taking RMDs out of your 401ks. You don't need the money anymore.
Yeah. So, guys, thanks for joining us. I hope we enlightened you on a topic that is often kind of overlooked and almost looked at and frowned upon. And we appreciate you guys joining us. So, again, I'm John Oliver.
Steve Livingway,
Nick Bohr.
thank you.